What follows is not meant to shock, nor to stir up short-term fear. This information comes from inside the United States banking oversight system, where silence is often treated as a tool for stability. 3 weeks ago, a senior examiner at the Federal Deposit Insurance Corporation, with more than 2 decades of experience, reached a conclusion that staying silent would cause greater damage. That decision may end his career, but it revealed a reality the public was never meant to see. After reviewing internal data, confidential reports, and bank stress test results that are never disclosed by regulation, the information was passed out through encrypted channels and trusted intermediaries. Investigative journalists spent weeks, and in some cases months, verifying and cross-checking every detail. The result was an internal list, 12 banks in the United States, that the Federal Deposit Insurance Corporation has flagged as unlikely to survive beyond the year 2026. These are not small rural community banks. They are large financial institutions with familiar names. They serve millions of customers, hold billions of dollars in deposits, and sit at the center of everyday economic life. Some currently hold personal savings. Some process payrolls for businesses. Others serve as home mortgages. According to internal assessments, these banks are moving along a path that is increasingly difficult to reverse. To understand why such information is never made public, it is necessary to understand the core philosophy of the Federal Deposit Insurance Corporation. Their primary focus is not reassuring individual depositors. It is preventing systemic panic. Their logic is straightforward. If the public knew exactly which banks were in trouble, mass withdrawals would trigger the very collapses they are trying to prevent. As a result, a complex system of confidential examinations is maintained. Internal ratings are kept secret by law. Public statements continue to emphasize stability, even while contingency plans are quietly prepared. This pattern played out before the collapse of Silicon Valley Bank. Months before the failure, regulators had identified serious weaknesses. Internal ratings were downgraded. Management was warned, yet depositors were told nothing. No public announcement was made. Most customers only learned their bank was in trouble when they woke up to headlines announcing its failure. Overnight, billions of dollars were frozen. Businesses could not pay employees. Families could not access their own savings. This occurred because regulators chose to protect the system rather than warn the public. It is within this context that the views of Warren Buffett become especially relevant. Throughout his career, he has repeatedly pointed out that banking is a uniquely fragile business. A restaurant can survive bad reviews. An automobile company can recover from recalls. A bank cannot survive the loss of trust. That reality explains Buffett's long-standing caution. When investing in financial institutions, he does not chase short-term growth. He does not focus on headline profits. Instead, he looks for disciplined management, strong capital positions, and diversified loan portfolios that can withstand economic shocks. To him, a good bank is one that remains standing when conditions deteriorate, not one that looks impressive during boom times. Over the past 2 years, Berkshire Hathaway's actions have reflected that mindset. Without dramatic statements, Buffett has sent a clear message through capital allocation. Exposure to the United States banking sector has been reduced methodically and deliberately. Billions of dollars in Bank of America shares were sold. Regional banks were fully exited. These were not emotional decisions. They were the product of long observation of risks accumulating within a system where trust, once damaged, is exceptionally difficult to restore. He did not rush to react. When 3 major banks collapsed in the year 2023, while many investors hurried to reassess risk and search for short-term explanations, Buffett remained on the sidelines, observing carefully. That calm was not indifference. It was the result of long preparation. He understood something that most of the market refuses to accept. When the Federal Deposit Insurance Corporation begins quietly preparing for bank failures, Smart money does not stay where it is. It moves elsewhere, silently but decisively, toward safer ground. What is unfolding inside the 12 banks on the internal watch list is not a single isolated problem. It is the convergence of three major risk categories, intertwined and reinforcing one another, forming a perfect storm of financial fragility. The first category is commercial real estate risk. After the pandemic, the way Americans work changed fundamentally. Office buildings across the country have remained partially or fully empty for extended periods. Companies that once leased entire floors now occupy only a fraction of that space. Some have eliminated traditional offices altogether. As a result, the commercial real estate market has entered a deep downturn. In some major cities, property values have fallen between 40 and 60% from their peak levels. Banks that issued loans backed by these properties are now holding collateral worth far less than the amounts owed to them. When a borrower defaults on an office building once valued at $500 million, but now worth only $200 million, the bank absorbs a loss of $300 million. Multiply this scenario across thousands of properties, and the scale of the problem becomes clear. All 12 banks on the internal list have commercial real estate exposure exceeding 200% of their total equity. This means that if only half of those loans fail, their entire capital base could be wiped out. They are not approaching a problem. They are already submerged in it. The second category of risk lies in unrealized losses within securities portfolios. This is the same mechanism that destroyed Silicon Valley Bank, and it has not disappeared. When interest rates were near zero, banks accumulated long-term treasury bonds and mortgage-backed securities. These assets appeared safe because they were backed by the government, but they carried a fatal weakness. When interest rates rise, bond prices fall. Over the past 2 years, the Federal Reserve has raised interest rates at the fastest pace in 4 decades. Bonds purchased at face value are now worth only 70 or 80 cents per dollar. As long as banks do not sell them, they can pretend the losses do not exist. They label them unrealized losses and exclude them from primary financial statements. The Federal Deposit Insurance Corporation sees through this accounting illusion. They understand that if depositors withdraw funds faster than cash can be generated, those securities must be sold, turning paper losses into real ones. The 12 leading banks are carrying total unrealized losses exceeding $90 billion. That is $90 billion that has effectively vanished, though not yet acknowledged. It is a ticking time bomb. The third category of risk is the most dangerous and also the hardest to detect from the outside. It is a liquidity crisis. Liquidity simply means the ability to meet withdrawals with available cash and liquid assets. In normal times, this is not a problem. Deposits move in and out predictably. Banks hold a small portion in cash and lend out the rest. The system works because not everyone withdraws at once. But these are no longer normal times. As interest rates increased, depositors began moving money out of traditional bank accounts into higher yielding alternatives. Money market funds now offer yields around 5%. Treasury bills provide similar returns with virtually no risk. Meanwhile, many banks still pay less than 1% on savings accounts because they cannot raise rates without crushing profit margins. The result has been a steady and persistent drain of deposits. In the year 2023 alone, more than $1 trillion left traditional banks and flowed into money market funds. This trend has not reversed. It has accelerated. The 12 banks under review are experiencing withdrawal rates that management never anticipated. Some have lost 20% of deposits over the past 18 months. Others are surviving only because the Federal Reserve created emergency lending programs, allowing banks to borrow against securities. at their original face value, rather than current market prices. These programs are temporary. They are like bandages placed on wounds that require surgery. When the programs expire, the underlying problems remain, larger and more dangerous than before. Against this backdrop, the internal list of the Federal Deposit Insurance Corporation begins to take shape, along with the data explaining why each bank appears on it. This information comes from insiders within the regulatory system, individuals risking their careers. To issue a warning, while not every detail can be independently verified, the risk patterns align precisely with publicly available data. The first bank on the list is New York Community Bank Corporation. Many remember the name from headlines earlier this year when its stock fell by more than 60% in just a few weeks. What is less widely understood is that the underlying problems have not been resolved. They were temporarily obscured by capital raises and management changes, but the fundamentals remain weak. Its commercial real estate portfolio is concentrated in rent-stabilized apartment buildings in New York City, a market damaged by regulatory shifts. And higher interest rates, loan loss provisions have increased by more than 400% over the past year. At the same time, the deposit base has shrunk as customers move toward larger and more stable institutions. Internal forecasts suggest that without a merger or acquisition, intervention may be required by late 2025. The second bank is First Foundation Bank, based in California, with heavy exposure to multifamily real estate. In markets that have seen significant price declines, its unrealized losses on securities now exceed its entire tangible equity. On a mark-to-market basis, shareholder value has effectively been erased. The bank continues to operate through accounting techniques and regulatory patience. The third bank is Customers Bank Corporation, which expanded rapidly during the pandemic. By attracting deposits linked to cryptocurrency activity, when the cryptocurrency market collapsed and regulators increased scrutiny of digital asset exposure, a large portion of deposits vanished almost overnight. Since then, the bank has struggled to replace those funds. At the same time, its concentration in commercial real estate in Philadelphia and New York has continued to amplify overall risk. The fourth and fifth banks, Valley National Bancorp and the Columbia banking system, are both carrying commercial real estate exposure that exceeds 250% of their risk-based capital. This is not an academic figure. For examiners at the Federal Deposit Insurance Corporation, this level is considered severe. A meaningful decline in their loan portfolios could quickly erode capital and force immediate regulatory intervention. The sixth bank presents an even greater surprise, even to analysts who follow the sector closely. This is Truist Financial, one of the largest regional banks in the United States, with total assets exceeding $500 billion. Truist was created through the merger of BB&T and SunTrust, two long-established Southern institutions, each with histories stretching back more than a century. On paper, the merger once appeared strategic, offering scale and competitive strength, but timing proved decisive. The deal closed just before interest rates surged. Integration costs, combined with massive unrealized losses in the securities portfolio and rising concerns over commercial real estate exposure, pushed Truist into an increasingly fragile position. The forced sale of its insurance brokerage unit, one of its most profitable businesses, was not merely a tactical choice. It signaled that capital pressure had reached a critical point, requiring the sacrifice of prized assets. For seasoned observers, this is always a moment worth reflecting on. When a bank begins selling its crown jewels to survive, the message is usually clearer than any earnings report. The seventh and eighth banks, Zions Bank Corporation and Western Alliance Bank Corporation, were heavily shorted during the banking crisis. of the year 2023. Astute investors at that time recognized their structural weaknesses. Both survived the initial wave of panic, yet their underlying problems remain largely unresolved. Zions carries commercial real estate concentration exceeding 300% of equity capital, particularly in markets such as Phoenix and Salt Lake City, where property values are undergoing sharp corrections. Western Alliance built its franchise by serving technology firms and venture capital-backed startups. When the era of easy money ended, this very customer base contracted the fastest. The ninth bank, Comerica, with a focus on Texas and California, has seen deposits fall by more than 15% as customers moved toward higher yielding alternatives. Net interest margins have been compressed. Operating efficiency has deteriorated. Meanwhile, commercial real estate risk continues to rise as borrowers extend and pretend rather than fully repay maturing loans. History shows that this practice tends to delay and deepen the eventual reckoning. The 10th bank, Popular Incorporated, the largest bank in Puerto Rico, faces distinct challenges stemming from the island's long-standing economic difficulties, while simultaneously bearing exposure to both commercial real estate and consumer credit in a market with limited recovery prospects. The 11th bank, Home Street, announced earlier this year that it was seeking a merger partner after management concluded that independent survival was not viable. The proposed merger has been repeatedly delayed due to regulatory concerns, leaving the bank in a state of limbo as deposits continue to decline. The 12th bank, Pacific Premier Bancorp, is a California-based institution heavily concentrated in the very segments of commercial real estate lending, now experiencing the highest default rates. At this point, many people naturally scan the list to see whether their own bank appears. If it does not, a sense of relief is understandable, but an important warning must be stated clearly. These 12 banks are not the only troubled institutions. They have merely crossed the internal threshold used by the Federal Deposit Insurance Corporation to indicate a likelihood of failure within 24 months. Beyond them, 63 additional banks remain on the Federal Deposit Insurance Corporation problem bank list. They have not yet reached the critical stage, but their trajectory is worsening. And beyond that, hundreds of other banks are under similar pressure from commercial real estate exposure, unrealized securities losses, and deposit outflows, even though they have not been formally flagged. The 12 banks just named represent only the visible tip of the iceberg. The submerged portion runs far deeper than policymakers in Washington are willing to acknowledge. In this context, Warren Buffett continued withdrawal from the banking sector is not driven by inside information about specific institutions. It reflects his understanding of the system as a whole, a system built on a foundation now cracking under the weight of higher interest rates, falling commercial real estate values, and deposits slowly migrating toward what are perceived as safer alternatives. To understand why this matters, one must see clearly how a bank failure actually unfolds. Such failures rarely occur overnight. They typically begin months or even years before the public becomes aware. Examiners from the Federal Deposit Insurance Corporation identify problems during routine inspections. They issue warnings to management. They require corrective plans. They increase supervisory intensity during this period. Everything appears normal to customers. Branches remain open. Websites function. Automated teller machines dispense cash. The only parties aware of the trouble are regulators, the board of directors, and senior management, all legally prohibited from disclosure. Under threat of criminal prosecution, this silence is maintained until the very end. When the Federal Deposit Insurance Corporation determines that a bank is beyond rescue, it executes what is often called the Friday night maneuver. Officials wait until markets close, take control of the institution, and spend the weekend arranging a sale to a healthier bank or preparing insured depositor payouts. By Monday morning, customers wake to find their bank no longer exists. If a buyer is found, accounts are transferred seamlessly. If not, depositors receive a check from the Federal Deposit Insurance Corporation covering insured deposits up to $250,000. Any amount above that limit may be lost permanently or only partially recovered after years of bankruptcy proceedings. This is precisely what occurred to customers of Silicon Valley Bank, Signature Bank, and First Republic. In the year 2023, thousands of businesses and individuals who believed their money was safe discovered overnight that access to their funds was cut off. Some nearly failed to meet payroll. Others could not pay suppliers. For those who have watched long enough, these episodes serve as a cold reminder of the cyclical nature of the financial system. The economic disruption caused by earlier bank collapses spread across entire communities. The damage lasted far longer than the moment the crisis first appeared. It is true that the United States government eventually stepped in. All deposits at three major banks were fully protected at that time. But careful observers understood something very clearly. There was never any promise that the same response would happen again. The Secretary of the Treasury, Janet Yellen, stated this directly. The actions taken in the year 2023 were temporary. They were an emergency response to systemic risk. They were not a permanent change in policy. This leads to a reality many people prefer to ignore. If one of the 12 banks discussed were to fail on its own, if that failure did not threaten the wider system, then depositors above the insurance limit would face real risk. This is not speculation. It is not pessimism. It is the official policy framework in place today. Anyone holding more than 250,000 United States dollars at a single institution is accepting a risk that most people have never truly been taught to understand. Through the lens of Warren Buffett, the issue is not fear. The issue is preparation. For decades, he has believed that protecting capital comes first. Profit is only considered after safety is secured. In the current environment, wealthy families and seasoned investors do not wait for confirmation. They do not wait for headlines or regulatory announcements. They act early. They act based on probability and structure. The first step is simple. Diversify deposits across multiple institutions immediately. There is a reason informed investors rarely keep more than $200,000 at a single bank. This figure sits below the official insurance limit by design. It allows room for interest and automated transfers. It creates a margin of safety. Those with larger savings accept inconvenience. They manage 3, 4, or even 5 banks. The inconvenience is minor compared to losing access to funds overnight. From Buffett perspective, convenience has never justified sacrificing safety. No single institution deserves blind trust, especially when regulators already see problems the public is not warned about. The next step is prioritizing the safest possible institutions. Not all banks occupy the same position in the system. The 4 largest banks in the United States are classified as globally, systemically important institutions. They face higher capital requirements. They face stricter oversight. Most importantly, the government cannot allow them to fail. The ripple effects would be catastrophic. This does not make them perfect investments. It makes them the safest places to store cash that cannot be lost. Those using regional banks, especially those already flagged, should consider moving primary checking and savings accounts to larger institutions. Smaller balances may remain at local banks for convenience. Beyond traditional deposits, prudent investors also consider alternatives. United States Treasury securities are direct obligations of the federal government, purchased through Treasury Direct. They eliminate intermediary risk entirely. Funds are held by the Treasury, not by a potentially failing bank. Money market funds that invest only in government securities offer similar safety with greater flexibility They are not insured by the Federal Deposit Insurance Corporation, but the assets they hold are backed by the full faith and credit of the United States government. For funds above insurance limits, these options deserve serious consideration. Another mistake Buffett often warns against is passivity. An open branch does not mean a healthy bank. Working machines do not prove stability. Those who understand the system monitor financial indicators themselves. Public tools allow anyone to do this. Regulatory data is available to all. Metrics such as the Texas ratio, commercial real estate concentration, and unrealized securities losses are not hidden knowledge. They are visible to anyone willing to look. What stops most people is the belief that someone else is protecting them. Regulators protect the system. They do not protect individuals. The final lesson returns to Buffett's core principle: do not wait for certainty before acting. When a bank failure reaches the evening news, it is already too late. Accounts are frozen. Control is gone. Only government decisions remain. For more than 60 years, Buffett has acted on probability, not certainty. He responds to warning signs early. He never waits for proof, because proof arrives too late to matter. The warning signs in the United States banking system have never been clearer. Commercial real estate is weakening. Unrealized losses continue to grow. Deposits are flowing toward higher yield alternatives. The list of troubled banks keeps expanding. The 12 institutions flagged as unlikely to survive past the year 2026 are only the visible portion. This information now sits with you. Most people will never see it. As Buffett said at his most recent shareholder meeting, the banking system is essential to national prosperity. But that does not mean every bank will prosper. He reminds depositors never confuse system safety with the safety of any single institution. Throughout his career, he has never regretted being too cautious. With money he could not afford to lose. Those words matter today. They matter while choices still exist. They matter before the next Friday night intervention arrives.